Hello to all of you out there in cyberspace, and welcome to today's Swesif seminar called Data Providers and the Taxonomy. We hope that you're taking care of yourselves and your loved ones during these troubled times. My name is Robert Vixai, and I will be today's moderator. As you probably all know, Swesif is an independent non-profit association founded in 2003 and has just over 100 members, most of whom are asset owners and managers. The association functions as a network and a meeting place for financial market participants with an interest in sustainable investments. Swesif arranges seminars, roundtables, member lunches where exchanges of insights and experiences can take place for increased knowledge and with the aim of contributing to the public debate. And now to today's agenda. On 21st of April, the European Union agreed on the new European climate law, which lays out the path for Europe to achieve climate neutrality by 2050. On the same day, an ambitious package of measures was also adopted for the first part of the EU taxonomy. As we all know, the first part of the taxonomy focuses on the climate and sets thresholds values for activities that are considered to significantly contribute to the goal of achieving net zero emissions by 2050, or that contribute to a countering of negative consequences of climate change. The Commission estimates that the first taxonomy covers activities of 40% of the listed companies in the European Union, which are responsible for almost 80% of the direct greenhouse gas emissions. The EU is now continuing its work on creating a taxonomy, also for areas such as protecting biodiversity, the transition to a circular economy, protecting oceans and water, and preventing pollution. These will be presented in separate delegated acts and most likely will also lead to further complications when it comes to an economic activity's eligibility to be considered sustainable. Usability of financial data has never been a perfect science, but we as financial market participants have learned to work around those problems by using smart approximations and assumptions. Sustainability data is not a perfect science either. However, lack of data has been sometimes used as a scapegoat to not act rather than an opportunity to create something unique. So in order for us as an investor community to better understand the usability of taxonomy data and maybe get over this hurdle of data uncertainty, we have invited 4 global data providers to give us their insights surrounding the solutions they have developed to fulfill the financial community's needs related to the EU taxonomy. Without further ado, I want to welcome our panelists today, and we will be listening to Thomas Harding from ISS-ESG. Thomas joined ISS-ESG in 2020 to lead the build-out of regulatory solutions, initially focused on EU taxonomy and SFDR. He has also worked as a client delivery manager for regulatory technology consultant focused on EU sustainable finance regulations. We also have with us Hanna Ogilvy from MSCI. Hanna is an ESG researcher at MSCI focusing on the taxonomy. She has previous experience in venture capital and wealth management, as well as private and commercial lending. We have Soeren Stoeber. Soeren heads up S&P's global ESG business development efforts for Northern Europe, Germany, and Africa. Prior to joining S&P, Soeren held corporate sustainability and reporting positions and worked for Wuppertal Institute for Climate, Energy, and Environment. And last but not least, we also have with us Schoemaker from Sustainalytics. Anne is a product manager at Sustainalytics. She is responsible for the strategy and development of EU action plan related products and services and has been spearheading the developing of taxonomy and SFDR solution for the past year and a half. For the sake of the order, after each presentation, I will ask one question to the presenter and then continue on to the next speaker. We will also have time for a 15-minute Q&A session at the end of the seminar, and I encourage you to write your questions in the chat box. There are no bad questions or stupid questions when it comes to the EU taxonomy. It's a complicated matter, so please ask your questions, don't be afraid. And with that said, Thomas, I leave the floor to you to start with.
Excellent. Thanks very much, Robert, for the introduction, and thanks to all of you in the audience for your time today. So in the interest of efficiency, given that I'm sure that we're all very familiar now with both ISS-ESG and the EU taxonomy regulations and requirements themselves. I'm going to jump straight into an overview of the EU taxonomy alignment solution, which we brought to market and launched in mid-January earlier this year. So in the top left, and working our way around this slide, first of all, in terms of the coverage, we have already expanded the universe to over 7,400 issuers that have complete data across the entire solution, from an initial standpoint of 6,700, and this universe is set to increase in line with our ESG corporate ratings universe throughout the remainder of this year. It's also worth highlighting that we have significantly enhanced coverage for both the revenue and the minimum social safeguard aspects of the taxonomy assessment at 20 and 24,000 issuers respectively. Then if we move on to the comprehensiveness of the solution that we offer, it includes over 400 specific EU taxonomy data points or factors, and those are made up from the 74 activities that are currently included within the solution today, times by the 5 different steps of the assessment process that you can see on the top right-hand screen, and the remainder are made up from the overall top-level company and issuer aggregation factors that I'll come on to display in a moment or two. Then looking at that 5-step assessment process, so we already cover all 5 of those steps within the solution with a 2-step do no significant harm assessment. Firstly, a reverse engineered check from the substantial contribution before, and secondly, looking at broader harm to the 6 objectives that are carried out within the taxonomy, and then finally a minimum social safeguards assessment that is conducted at the overall company and issuer level. Finally, on this slide, looking at the granularity of the results, and one of our key differentiators here at ISS-ESG, we go above and beyond just a binary classification of a yes, no, true or false assessment to provide an indication of possible alignment as and when more data from the investee side of the market becomes available. Next slide, please. So going into that assessment in a little bit more detail and looking at the potential iterations of results that are generated by the model today, we've got the aligned and the not aligned sections on either end of the spectrum, which, as I'm sure you're well aware, require fully verifiable and directly aligned taxonomy reported data from the corporate side of the market. But because right now we're not seeing that level of disclosure forthcoming from the investee side of the market, we decided to introduce the additional possibilities of alignment, which include likely aligned, potentially aligned, and likely not aligned, and the different combinations of results that are required to arrive at each of those 3 outcomes displayed on the screen in front of you. Next slide, please. So here, this is a screenshot of the data desk platform that we have here at ISS-ESG, effectively our one-stop shop offering for all of our underlying data sets and services. And what I've decided to set up here is, first of all, a capture all type screen, looking for companies that have aligned revenues of greater than or equals to 0. And as mentioned earlier, a universe of just in excess of 7,400 or so companies. Next slide, please. This screen here takes a more restrictive look at the overall universe of companies that are generated, looking for those that have likely aligned revenues of greater than 0. And you can see a much smaller overall universe of companies that are returned by this screen of in the region of 174 out of the 7,400 or so. And then in terms of the column configuration that you can see there in front of you, those are the top level overall company and issuer aggregation factors. Next slide, please. This slide takes a slightly more permissive look again to include those issuers that have potentially aligned revenues of greater than 0 as well, bringing the universe to in the region of just under 1,000 issuers. And in terms of the column spec that's showcased here, the next level of granularity down included within the taxonomy offering, looking at the overall alignment result for each and every one of the 74 activities included within the solution today. Next slide, please. This next screen setup takes a more permissive view again, looking for those companies and issuers that have relevant activity involvement. So that is to say that they derive revenue from one of the activities that is captured beneath the taxonomy and beneath its 6 objectives, regardless of the alignment level and not having gone through the entirety of the 5 steps of the assessment process. What you'll notice as well on the screen in front of you is that we also have a really neat summary snapshot view of all the relevant activities that a single issuer or company is involved in, showcased here with the nice, neat hover over functionality highlighting the activities that this company in question, and you can see the identifier has been mostly blanked out for this purpose, but hopefully you can make out the single digit 7 in the far left hand side. Next slide, please. So this slide takes a more detailed look again and the most granular level of view that's included within the taxonomy solution on DataDesk to date, looking at the individual steps of the assessment process for a specific activity in question. And here we've got building acquisition and ownership and involvement, one of the largest and most populated activities that we're seeing today in the region of 500. And then the column configuration setup shows those steps from the overall alignment as well as the individual steps of the 5 steps of the assessment process. And one additional point to highlight here is that if you are particularly interested to understand why the issuer 7 in this instance has arrived at a likely not aligned result for the substantial contribution step of the assessment for building acquisition and ownership, you'd be able to effectively dig in deeper to understand how and why we've been able to arrive at that result by leveraging our underlying data transparency file that we are also providing to users of this solution to ensure that this product is not likened to or compared to a black box type of offering. Next slide, please. This slide then shows a very quick, neat summary snapshot view again of that overall relevant activity overview for the company and issuer 7, as you can see in the top left-hand corner of this slide, looking at their EU taxonomy aligned data alongside other different data sets that we have here via the Explorer tool within the DataDesk platform that we offer. And then finally, the last slide, please. This slide aims to showcase the automated portfolio analysis and reporting capabilities that we will be bringing to the market, anticipated before the end of Q3, so sometime around July and August, which really at the click of a button aims to tick all of the boxes from an EU taxonomy a compliance perspective by splitting out the alignment levels, not only by relevancy and not relevant, and then their different levels of alignment, but also by the individual objectives as well of climate change mitigation and climate change adaptation for now. And we are fully committed to expanding that out to covering the 4 remaining objectives as and when they are brought into scope. And that concludes my presentation. Thanks very much, Robert.
Thank you, Thomas. And just a quick question. We don't have time to deep dive into all the details, but I do want to ask you one question. If I'm looking at your presentation, one of the concepts that sticks out is the aligned, likely, potentially, likely not. Very difficult concept to quantify if you are a quantitative asset manager. I understand if you're a fundamental manager, you can go in, look at specific companies, you can understand the data, but how do I use that framework the best possible way as a quantitative asset manager?
Yeah, thanks, Robert. Interesting question. So, I mean, as highlighted in the slides that I presented a moment ago, the results for likely aligned and fully aligned are exactly identical, but in some shape or form, we've leveraged a proxy, approximation, or calculation within that assessment to make it not fully verifiable criteria. And as a result, we're providing that aligned or likely aligned granularity to be transparent and reflect the level of confidence in light of that lack of EU taxonomy aligned data from the investee side of the market, that we have when making those assessments. And ultimately what clients do with that then is up to them, I suppose. But I'd say that actually the use of likely aligned should be relatively straightforward in the end, and it depends on the client's own choice of how strict they want to be with regards to EU taxonomy assessment and compliance and reporting. So once the client has made the decision that they're okay with leveraging proxies in the absence of directly reported and verifiable data, then they can certainly use the likely aligned result as an indication of alignment, where that data behind the likely aligned result is as well also quantifiable due to the fact that it shows a percentage of revenue. So hopefully that provides some useful insight there.
Yeah, it gives a little bit more depth, and we will talk about more about proxies later in this presentation. So Hanna, please take the wheel.
Good afternoon, everyone, and thank you, Robert, for inviting MSCI to participate in the panel. For those of you who don't know MSCI, we're a provider of decision support tools and services for the global investment community. And these tools can range from index products to analytics, real estate, ESG ratings, and of course, today's topic, the EU Sustainable Finance Solution. So with that, one key trend I wanted to highlight for today's discussion is transparency. And the taxonomy really hinges on transparency, and I'll tie back to this at the end of the presentation. So for today, I'll focus on how we've developed our taxonomy solution as part of our larger EU Sustainable Finance module. I won't spend too much time on this slide, but there are a few key definitions I wanted to highlight. So what is the taxonomy? It outlines economic activities and criteria by which a company can report a percentage of their revenue, capital expenditures, or operating expenditures as green. And according to the regulation, for an economic activity to be considered taxonomy aligned, it must significantly contribute to one of the 6 environmental objectives that you see on the slide here. It must do no harm to the remaining 5 objectives and meet minimum social safeguards. Next slide, please. So I'll talk for a moment about the overarching challenges investors face with regards to calculating taxonomy alignment, which will help explain why the technical expert group's recommendations introduced a concept of potential taxonomy alignment. By and large, the biggest challenge is the availability of the data. The criteria from the draft delegated acts focuses on activity level thresholds and thus relies on specific activity level disclosures, not entity level disclosures. And as we've highlighted on this slide, based on existing company reported disclosure alone, less than 5% of companies in MSCI's ACWI Investable Market Index, an index of nearly 9,000 global issuers, would be considered as having some eligible or some aligned revenue. Based on MSCI's approach, which I'll get into, we find that more than 25% of companies in the reference index have some aligned revenue or eligible aligned revenue. And this gap in percentage of alignment is driven by lack of activity level disclosure by issuers, making it difficult to determine taxonomy alignment with company reported data alone. So on the next slide, please. So this slide goes into this topic further. The expectation is that companies are reporting activity level turnover, including specific greenhouse gas emissions levels and other relevant KPIs for each activity. The reality is that companies don't report granular economic activity breakdowns. In fact, we found nearly half of the companies in MSCI ACWI IMI report revenue under only just one business segment, and it's unlikely that these companies are pure plays. Another similar challenge is the case where a company does report revenue by business segment, but those don't correspond to taxonomy eligible activities. So we looked at a major oil producer who did in fact report a revenue breakdown based on the categories you see on the slide here: integrated gas, upstream, etc. None of these segmented activities are defined as potentially green in the taxonomy. However, when you look deeper into the company's activities, you find that almost 10% of companies, almost 10% of this company's revenue comes from alternative fuels and pollution prevention, which would be considered eligible revenue under the taxonomy, yet you wouldn't glean that information from the company reported revenue alone. So fortunately, MSCI had its own green taxonomy, whereby we are looking into companies' involvement and activities and determining the percentage of the revenue associated with sustainable activities, as we did with this oil major. And so you see this in more detail on the next slide. Here we have our environmental impact metrics, which represents a framework many of you may be familiar with, as we've been offering this particular solution to clients for several years. We have a dedicated team that researches companies based on their activities, regardless of industry or company reported business segments, and calculates an estimated percentage of revenue from each of the activities that you see on the slide here. And we found that both the themes, meaning the covered areas, as well as the output, the estimated percentage of revenue, broadly overlapped well with the taxonomy objective areas. So with that, we had a good framework to identify estimated taxonomy aligned revenue. On the next slide, this next step in our analysis was to look at the do no significant harm and the minimum safeguards. And with this step, we faced different challenges. On one hand, do no significant harm criteria is quite detailed and nuanced, but on the flip side, minimum safeguard is quite broad and doesn't set specific thresholds for what constitutes a violation of the standards. And so we solved both of these challenges by applying our controversies and global norms framework. This framework looks into a company's involvement or activities based on news, reports, and media that have some adverse impact. We have different pillars for researching controversies categorized as environmental controversies, which maps quite well to do no significant harm criteria, as well as governance and social controversies, which maps quite well to the minimum safeguard. The next slide, please. So this slide presents kind of a summary of the building blocks to our approach to taxonomy, which I've presented. First, as I mentioned, we leverage our environmental impact metrics to identify involvement and revenues in green activities. Then we exclude companies with severe and very severe environmental controversies as an indication of failing the do no significant harm criteria. And similarly, we exclude issuers who have very severe social and governance controversies as a proxy for meeting minimum safeguards. And here I should mention that we also exclude tobacco producers and issuers with controversial weapons based on our understanding of the EU's take on these industries meeting social guidelines. MSCI has been in a number of engagements with the EU's working groups throughout the development of these regulatory frameworks, and we believe that these industries will be kind of excluded from the EU taxonomy. So with these screens, which are quite stringent themselves, we arrive at 27% of ACWI IMI index that has at least some estimated revenue from taxonomy aligned activities. And of course, we provide for our clients the percentage of estimated revenue for each issuer accordingly. Next slide, please. And so lastly, I just want to zoom out to a higher level to what MSCI is doing on the topic of transparency and regulatory reporting. So first, MSCI ourselves is a corporate initiative to increase our own ESG transparency, which is why we've published our ESG corporate ratings tool and ESG fund ratings tool publicly on our website, covering thousands of issuers and nearly 40,000 funds. Relating more to the EU Sustainable Finance Package, we've really compounded the efforts of our robust rating business and built out our research process for the EU taxonomy, and we'll continue to leverage this to strengthen the EU solutions. And with that, I'd encourage you all to subscribe to our specific EU Sustainable Finance newsletter to stay up to date on this product offering. So that is our very brief, high-level overview of how and why we've determined our methodology. And I think in the interest of time, Robert, I will turn it back to you.
Thank you very much, Hanna. Very good of you to present. And I know that we are short of time, but I do have a question. And having worked a lot with controversies data, and it seems that you leverage the MSCI ESG controversies framework for the do no significant harm criteria. So how were these thresholds for controversy scores set for these standards? Could you deep dive a little bit more into that?
Yeah, it's a good question. I'm happy to clarify that. So the challenge here is really, how do we define what is significant harm? And so our methodology for assessing severity of impact takes into consideration both, one, the nature of harm, whether it's temporary or permanent, and two, the extent of harm, whether it's contained and widespread. So while there may be some debate of the severity of some cases with moderate impact and scale, I think we can all agree in events that are widespread and long-lasting or permanent damage to the environment should be considered significant. And these types of events are assessed as severe or very severe, or for those of you who are familiar with our flagging system, red and orange flag events. For social controversies, there's more ambiguity in the role of the issuer in the long-lasting harm in society. So we only kind of include red or severe controversies flags, but also exclude activities that have adverse impact on communities, such as I mentioned, tobacco production and controversial weapons. And actually, while working with a large EU-based pension fund, we engaged with the OECD to review the scope of MSCI's ESG controversies against the OECD guiding principles, as well as the framework for assessing severity. And this gave us the needed confirmation for the relevance of our methodology focused on scale, scope, and the character of the impact. So we also confirmed that the types of controversies that we assess map almost entirely with the areas covered by the OECD principles. And I use kind of almost entirely in quotes because we capture slightly more types of events in areas of consumer protection and corporate governance. So in short, to answer your question, we tried to remove subjectivity from our analysis and focus on what is, without debate, considered severe and very severe when setting the do no significant harm threshold.
Thank you, Hanna. I do have follow-up questions, but I will take that later on. Soeren, it's your turn. Thank you.
Great. Thank you very much to my previous speakers and Robert, to you as well for moderating. What I want to do in my time is to provide a bit of an overview of how we think about the EU taxonomy at S&P and our approach and how we support our clients. If we go to the first slide, I don't want to go into detail here because that was already touched on to some extent, but I think what's important to remember is that the EU taxonomy really acts as a classification tool, first of all. So it seeks to provide clarity for companies, for capital markets, and for policymakers on which economic activities are sustainable. And secondly, it also acts as a screening tool. So it really seeks to support investment flows into those more sustainable activities. But we are all on this webinar, and I think at over 550 pages and much more to come this year and probably over the next couple of years, the taxonomy can be quite daunting even to the initiated. But really at the core, the definition of what constitutes a sustainable activity. And if we go to the next slide, this is really kind of where we started with our approach as well. So can we already say to what extent certain economic activities are eligible for the taxonomy? And so that's our first step. We released our EU taxonomy revenue share data set last year, and that's applied in the market and used by our clients. And I want to talk about that a little bit more before I talk about the other steps in the assessment. So if we go to the next slide, kind of opening up a little bit about what we're doing at S&P and what we really consider as the building blocks for our EU taxonomy offering. The first thing I think is what I want to say here is that although there is not enough data available, there is some data available in the market, and we can use and leverage that data. And so what we are looking at is we're looking at the existing data sets that we have at S&P, primarily around our true cost data sets. So that's a lot of very granular environmental and climate data, and also our SAM ESG scores and assessment data. And so we cover around 17,000 listed equities and around 6,500 private companies for which we have those very detailed environmental performance data point. And we apply and leverage that to look at sector revenue eligibility, and then look through to the thresholds eligibility and also the do no significant harm. And so if we go to the next slide, what we started with is really to look at the revenue eligibility. And what we try to do is to understand from our existing data that we have, how can that be mapped across to the 67 business activities that are highlighted in the economy. So at True Cost and S&P, for the environment, for the companies that we cover, we break their revenue down into 464 very granular business activities. And so we were able to map those to the 67 business activities and also break them down into transitional activities and enabling activities. Transitional activities being activities that significantly contribute to climate change mitigation, and enabling activities being activities that are providing products and services that improve the emission intensity of other activities. And so how is that applied? So if we go to the next slide, there's just one example where we can actually apply that to an investment portfolio, be it listed equity or fixed income. And that provides you with a very good view, first view on the portfolio revenues that are currently eligible for the EU taxonomy. And so the way we think about it is that that's really a useful starting point in identifying companies that have the potential to contribute significantly to the low carbon transition. And we launched that as well because we thought, there's still a lot of development ongoing, but we wanted to give that initial revenue alignment product to the market. If we look at the next slide and kind of how we look at the next steps, so how do we look at assessing the substantial contribution, the do no significant harm, and the social minimum safeguards, that's something that we are working on to release and to be released in the second half of this year. So we're working on it at the moment. But I wanted to open up kind of the black box a little bit and show you one example just to make that a bit more concrete. So if we go to the next slide, where we're looking at climate change mitigation, one of the 6 objectives under the EU taxonomy. And we've just picked one example here, construction and operation of electricity generation facilities that produce electricity from concentrated solar power, so quite a mouthful. But so how can we look at the metrics and thresholds, and how can we look at the do no significant harm for the other 5 elements? And so we look at quantitative and qualitative. If we go to the next slide, we're trying to understand what the metrics and thresholds are, and then we're applying our existing data sets and existing data collection processes to those specific quantitative thresholds, using primarily true cost data. And then also on the qualitative side, we're using data that we collect via our corporate sustainability assessment by SAM. And then going to the next slide, and that's already kind of the final slide, really, where we would look at the do no significant harm. So we're trying to go into as much detail as possible to establish these other criteria here. Again, looking at adaptation, water, circular economy, pollution, ecosystems, and leveraging across our different data sets the metrics, the targets, the information that we can leverage. So there's a lot of work ongoing. And we know that there will be more text and more technical requirements launched soon by the EU. But I think to summarize, there is already data available that can be used and can be applied. And we expect, of course, as this becomes relevant for the issuers as well, that we can collect more data over time. But I think I've reached my 7 minutes almost. So Robert, I try to be very efficient here. So back to you. Thank you.
Thank you for that, Soeren. And yes, you've reached your limit, but it was good. One of the key components of your assessment is the transitional activity side. And those are defined by the EU taxonomy as those that could significantly contribute to climate change mitigation based on their capacity to improve their emissions intensity. So somewhat, it's clear, but it's still a little bit subjective. Could you describe in a little bit more how do you assess that in your methodology?
Yeah, happy to do that. So I think it's there are a number of requirements that contribute to the definition of the EU. So for example, those transitional activities would require the greenhouse gas emission levels correspond to the best performance in the sector or industry. They must also not hamper the development and deployment of low carbon alternatives, and they must not lead to a lock-in of carbon intensive assets. Plus, there will need to be some form of assessment around the credible path towards climate neutrality. of those activities. And so one thing that we have always done at Trucost is that very granular breakdown of activities. And so there is a lot of detailed knowledge within S&P on that. And so we're kind of using that expert knowledge and that expert assessment of our analysts as well to exactly define if an issuer qualifies or parts of an issuer's revenues comply with those requirements. And that enables us to kind of break down these activities into enabling and transitional.
So a lot of fundamental review and fundamental analysis behind your methodology. That's what you're saying, if I understand correctly.
Correct. Yeah. Thank you.
Thank you, Soeren. We'll get back to you a little bit later. Anne, please.
Thank you, Robert. And thank you for inviting me to speak here as well today. My name is Hanna Schoemaker. I'm a product manager at Sustainalytics, and I'll touch a little bit on the taxonomy solution that we have available. Because Morningstar Sustainalytics have a taxonomy solution available today, which allows you to understand how your holdings, your portfolio align to the taxonomy, specifically to the climate change mitigation objective. We are working on the next iteration of our product already. That's meant to come out in a couple of months from now, where we will be adding significant additional modules and research, but I'll get to that later. Next slide, please. So my fellow panelists have already talked about the various, the building blocks of the taxonomy. We group them in three, so substantial contribution, do no significant harm, and minimum safeguards. For substantial contribution, we leverage our sustainable products research, or more specifically, the green revenue research element of that data set, which is a proxy for substantial contribution. What we are working on is activity-based research, and that means that for the companies that we cover, we'll be able to know exactly the percentage of revenues and CapEx and OpEx that they have associated with taxonomy activities. So this is something that's coming in the next couple of months and is a very meaningful expansion of the data set. It allows for a very granular assessment of eligibility as a starting point. Then for the do no harm criteria, the driving factor is our controversies research. So we consider severe and significant controversies to be breaches of the do no harm criteria, environmental controversies, of course. And as an additional signal, we also look at our environmental management indicators. So there might be cases where we haven't seen an actual breach of the criteria yet, but we see, for instance, a low management score on a particular issue. So then we would flag that as a potential, as a heightened risk for future issues. For the minimum safeguards component of the taxonomy, we predominantly use our global standard screening. And this is our market-leading norms-based product, which considers compliance of companies with international norms and standards, such as the OECD guidelines, UN guiding principles, UN Global Compact, so very much in line with the minimum safeguards. And in addition, as an additional safeguard, we also consider our social and governance controversies research. Next slide, please. So what does this look like? And we've decided to keep it simple in terms of top-level outcomes, top-level conclusions for a company. And we believe that's also in line with what ESMA, for instance, recommended in one of the latest consultation papers. So a company will have a percentage aligned revenues and a percentage not aligned revenues. Underneath that, of course, there's the assessments of the different components, so substantial contribution, do no harm, minimum safeguards, all of those need to be passed. But on the top level, it's fairly straightforward. Of course, we break that down. So for aligned, we would break that down into aligned reported revenues and aligned estimated revenues. For not aligned, it's similar, reported, estimated, or not eligible. So this means a company is involved in activities that are simply not covered by the taxonomy. So again, top-level data is quite simple. Underneath that is a very rich data set with company conclusions, breakdowns, also on enabling transition and on contribution activities, So all the necessary data points you would need for reporting, as well as underlying data sets with activity level assessments and the underlying data that we use to draw these conclusions. Next slide, please. So as an example, the top level outcome for Tesla would be that we consider them to be, that we estimate them to be 87% aligned. They've passed the do not harm and minimum safeguards criteria. However, we do also provide a watch flag in relation to the minimum safeguards, and that's because we've seen a controversy over alleged anti-union practices and poor occupational health and safety standards at a plant in California. And again, underneath this is a very rich data set with all the necessary activity level and company level data to be able to really understand what drives these conclusions. Next slide, please. So we deliver this data currently via data feeds, an API, Excel, of course. We have a managed portfolio service, and very soon the data will be available on screen as well. The data set is large. The taxonomy is complicated. The taxonomy methodology, therefore, is also fairly complex. So we've broken down the data set into 3. Level 1 data, which is the top level company data that you need to report to understand the basics of how, if and how a company has eligible revenues, CapEx or OpEx, and aligned revenues, CapEx, OpEx. There's a level 2 data set, which has the activity level assessments and conclusions. And there's a level 3 data set, which is the underlying data that we use to derive all the conclusions. So there's full transparency around the methodology, full transparency in the data used as well. Next slide, please. So what can this be used for? I think that level 1 data set is particularly useful for portfolio management and reporting. The more granular and detailed data sets are particularly useful for company screening. For instance, screening out a company that is not compliant with the do no harm criteria or the minimum safeguards criteria, or to screen on companies with a certain minimum level of eligibility or alignment in particular taxonomy activities. The level 2 and level 3 data sets can also very much be used for product and fund construction, of course, and for engagement, because you'd have all the details available to engage with corporates on their alignment or on their potential breaches, for instance. Next slide, please. Thank you. So just a few words before I wrap up on what we're developing. As I said, we have a solution available today. In the next couple of months, we're launching the next iteration. The main addition to that research is this economic activity-based research. We follow the EU classification system, the NACE system. So we have details on all those activities, revenues, as well as CapEx and OpEx, although CapEx and OpEx is less available, less reported on than revenues. But where it is available, we collect it, and where we can, we estimate it. We'll have leveraging Morningstar's portfolio and fund capabilities. We'll have portfolio aggregation and reporting options, as well as fund alignment assessments. And of course, once corporates start reporting taxonomy alignment and once funds start reporting their alignment, we'll collect that. What's not mentioned on the slide, but is, of course, as soon as the other 4 objectives come online, we'll include those as well. And I just want to mention, of course, we have comprehensive solutions around the other big regulation, SFDR, also.
Thank you very much, Anne. I do have a question, and this is a topic we haven't discussed before, and it's the minimum social safeguards part of it, and supply chain due diligence and questions related to a lot of companies in Europe. How is that incorporated into your data set and assessment of taxonomy eligibility?
Yeah, it's a good question. So once we've established that a company is involved in taxonomy activities, so has eligible activities, then we look at the do no harm and minimum safeguards aspects. And in the controversy research and our management indicator research, we look at both the company itself, but also how they manage the supply chain. So that's due diligence, in the supply chain, but also supply chain issues, community relations, labor relations, health and safety, etc. So we take into account the company's management strength as it pertains to supply chain issues, as well as severe incidents in the supply chain if they occur.
And that would show up as a flag, like the Tesla case that you showed us before, rather than, okay, good. Okay, I would like to welcome all of the panelists back with camera so that everyone can see you. And we do have one question in the chat. I will ask that a little bit later. Let's start with the key question here. And when analyzing your data sets, one can conclude that because of missing company reported data, all of you have used a great deal of proxy. And that is, when you use proxy, you use one data set to emulate or estimate another set of related data sets. So we all know that there is a great need of proxy, but at the same time, it creates further uncertainty in regards to how companies are performing. I know that your position is to proxy because you've all used it, so I'm not going to ask that question, how you feel about proxy or not to proxy. But what are the methodologies you will use when you do not have the exact data that is required by the taxonomy? So let's start with Thomas, because Thomas hasn't been speaking for a while now. So, and then I'll give the word to Hanna, Soeren, and Anne.
Sure. Thanks very much, Robert. So I think currently, first of all, and first and foremost, we just don't really have very much choice right now other than to apply proxy data. Company reported data from the investee side of the market just simply is not there. Now, having said that, we've put a great deal of work into analysing the technical screening criteria and ensuring that our proxies make sense. We don't just use kind of any old proxies, but only those which are absolutely justifiable. And we're very much comfortable with our choices and are able to stand behind them. We've aimed to stick as closely as is possible to the regulatory requirements throughout the development of this solution, and particularly when it comes to the do no significant harm check. And we believe that we go the extra mile there and apply proxies for activity specific requirements where perhaps others may only conduct a generic controversy check. Now, that being said, where there are just no proxies available whatsoever, or it was not possible to make assumptions based on either industry practices, region of operation, etc., we don't force the issue and are much more comfortable in making sure that we deliver accurate data and on a fully transparent basis towards our clients and users of this solution. So yes, overall, we believe that we need proxies, but also that they need to meet a minimum standard of truthfulness in order for the regulatory standards to be upheld. Otherwise, it just undermines the entire purpose of the taxonomy itself.
Hanna? Thank you, Thomas.
Yeah, and I don't want to, as you mentioned, there's a need to proxy, so I won't spend too much time on that. But I want to highlight two quick things first, is to make sure that we're all understanding this, is that I think it's about 2/3 of EU investment assets are non-EU based. So long as the EU taxonomy is not applied globally, there's always going to be some need to potentially apply a proxy. Additionally, I think more interestingly, when we talk about proxy data, I think it's important to note that there is some potential subjectivity of disclosure when the EU taxonomy doesn't provide specific, screening thresholds. I think it's a question for investors, like how comfortable are investors with companies' own assessment of adverse impact or their own assessment of reporting, severe violations of OECD norms, especially considering that neither the OECD nor the EU Sustainable Finance sets definitions for what constitutes a severe violation or even a violation. So these are just a few things I think to consider when asking if you should use a proxy or if it's the right thing to perhaps do. In terms of MSCI's proxy methodology, in one area to our approach that's really different is the starting point. And I think highlighting this will illustrate why we chose to use our impact metrics as a proxy. So the EU prescribes using company reported revenue breakdown to identify activities covered by the taxonomy, and then apply technical screening criteria to see if those activities meet the eligible criteria. And this is where we can see a significant disclosure bias challenge. And of course, we can and should leverage reported revenue categories, but it's certainly not enough data. So instead, we start by reviewing all 10,000 plus issuers across markets and industries for evidence of involvement in any sustainable impact activity using a wide range of reports, articles, investor presentations, and then estimate revenue involvement based on available disclosures. And lastly, I'll just note that the information MSCI uses to calculate our figure for taxonomy alignment, by this I mean the underlying factors like revenue breakdown, controversy flags, etc. It's all information that's included in our sustainable finance module and available to clients. So this gives investors kind of the flexibility to view our estimates and adjust some of our assumptions if they feel they want to apply their own different proxies.
Okay, Soeren?
Yeah, I think that there were a lot of, very good comments already. So I don't want to say too much on that, but I think we also use proxy data because there is in fact not enough data. However, whenever we can find or collect data, we try to do so. And there are some elements, if you think about energy production by source, where we have collected data over many years bottom up, and we're engaging with the companies we cover every year to see if disclosure has improved. So I think where it isn't available, we need to use proxy. We need to engage with the companies to further enhance the reporting. And I think we also need to be careful about the type of proxy we use, because I think you mentioned the example of renewable energy production, right? So I think we need to there look at whether we can break that down even further. So there are, in our system, we use different types of sector classifications for different types of renewable energy production. So I think if we use proxy, then going as detailed as possible and breaking that down, making it country specific or energy production type specific, that will really help us to get closer to the truth in the absence of disclosure.
Thank you, Soeren. Any final comments on the topic?
I'll try not to be repetitive. So the way we do it is we use our sustainable products research, which we've mapped very carefully onto the taxonomy activities. So, we also take a conservative approach, right? The taxonomy, one of the aims is to reduce greenwashing. So what we certainly can't do is inflate alignment numbers. So we look very carefully whether and we call them green safeguards of our methodology, whether they meet or are very close to the technical screening criteria. If so, we use them as a proxy. If not, then we're conservative and we estimate that an activity is not aligned. More generally, I think under the SFDR regulation, the regulators are quite clear that there is a lack of data and that they've indicated you can use estimated data. Ideally, you get it from the investee company first. If that's not available, you estimate it or get it from a third-party provider. For the taxonomy, it's yet to be seen, I think, what approach they'll take. We've seen, first of all, a couple of months ago that they entirely dropped the recommendation to use potentially aligned as a category, which foresaw it for those cases where there isn't enough data, but you do have enough assurance that an activity is aligned. They dropped that recommendation. Who knows what they'll do about companies outside of Europe and proxies.
Thank you. So what I'm hearing you tell me is that you don't force the issue. You try to be as granular as possible in all cases and rely on your history and back analysis. But there will still be a subjectivity in some classification, you indicate, and that the proxy is necessary, but at the same time, a little bit uncertain of what the regulators will do when we come to the final hurdle there. I have one more question coming in the chat, but before we go to that, I have one final question I want to ask you, and this is, you need to keep it a little bit more brief here. The turnover, CapEx and OpEx, those are three very important parameters that we need to start working on, both in investment decisions, but also from a reporting perspective. Where are you in the journey when it comes to that? You touched upon that, Anne, a little bit during your session. Are we expecting that to be launched during the fall, or are we, hoping? Put it that way.
In our case, around the summer, we are launching a data set which includes CapEx and OpEx as well. As I said, OpEx is not very much available, CapEx much more, but revenues is definitely the predominant metric.
Soeren, you can.
Yeah. Again, another difficult one. But so on CapEx, we as part of our standard environmental data set, we already provide CapEx for fossil fuels and energy where it's available, but that needs to be further expanded and then probably also collected. As Anne said, OpEx is even less reported.
Thomas?
Yeah, thanks, Robert. So I think we're in a relatively similar position to most in that we are already conducting numerous conversations with our data strategy collection and research teams on how we can support these efforts ongoing. There's some specific recruitment that's happening around collecting that CapEx and OpEx data, but not wanting to be repetitive of what others have already said, that CapEx and OpEx data is just lacking right now out there in the market from the investee side of things, and we hope and expect to see that increase over time.
Hanna?
Yeah, MSCI actually recently launched the Green Capital Expenditures tool. So driven by this new solution, since we're already collecting this data, focusing first on utilities and energy, just based on the definitions and those industries reporting tend to report more. So we hope to see more data coming from the CSRD regulation, and along with this kind of Green Capital Expenditures tool, we'll be adding this info into our taxonomy solution as it progresses.
Thank you. I mean, this is one of the most important questions. I mean, we can set up several strategic initiatives and commit to several goals, but if we don't invest in it, it will have consequences. And the CapEx is one of the key parameters to actually follow those strategical commitments. And this relates to the question that we got through the chat also. It's basically stating, how will the outputs from the taxonomy alignment reports impact the valuation of companies and portfolios? If, let's say, 5% is reported as a line, will this be rewarded? And if so, how? And how will the 95% non-aligned activities be affected? Now, this is a little bit speculative, but still worth exploring. So I'll give anyone who wants to start a first chance. You seem... Thomas, I'm going to point at you.
Very happy to do so, Robert. Thanks for pointing the finger. I was actually just taking myself off of mute as you handed me the mic. So I think from my perspective, we'll certainly begin to see those that have taxonomy aligned revenues being rewarded with additional investment from the institutional capital side of things. I think it will work both ways. Those that have some levels of alignment will see themselves attracting additional investment through, over time, the creation of EU taxonomy aligned specific portfolios, products, etc., and funds. And then similarly and conversely, on the other side of the equation, those that have no taxonomy alignment or taxonomy relevancy themselves may well miss out on those types of opportunities to attract that additional investment. And so I think it's only a matter of time before we see taxonomy alignment playing out into the financial side of things.
Okay. Soeren?
Yeah, good point. I think, the purpose of this whole taxonomy and the action plan is really to reorient capital flows towards sustainable investment and to achieve sustainable and inclusive growth. And so it's a drive to change. So we interviewed the head of the UNPI recently, and he said this is a revolution. And so this will ultimately, I think, impact on these type of questions that were asked in the chat as well, because that's what it is intended to do ultimately. So yeah, very short and sweet, but I think that's basically it. Yeah.
Thank you, Soeren. Hanna, you're unmuted yourself. Any input into the valuation?
Yeah, I don't want to speculate, but I sit on the research side, so it's something that this is interesting for us to look into, right? And I think an interesting outcome will be, do we see more behavioral changes from investors wanting to shift into things that are more aligned, or do we see, marginally more change in behavior from companies who are now feeling the, incentive to change their behaviors and, their own sustainability? So it's something that I think is interesting. I don't know if I'd want to speculate yet how that will transcend, but yeah, we'll see.
Thank you. I mean, it's purely speculative, of course. It's a push and pull kind of scenario here, but it will probably have some effect. And I'm going to ask you the next question directly. So you're going to be first now, and that's also a question we got through the chat. And this will be the last question during our ordinary session, just so that we can conclude. But we will have an opportunity to ask more questions after the ordinary session is done. To what degree do you expect the fund classifications under SFDR to follow the EU taxonomy? And do you think it is likely that some fund classification will change once the taxonomy start applying, either upgrade or downgrade? So you get the first chance, Anne.
Yeah, it's an interesting question. I mean, I think it's pretty general knowledge, or at least the assumption, that taxonomy alignment, even of Article 9 green funds, will be very low in the next few years. So I wouldn't expect fund classifications per se to change as a result of taxonomy alignment. That's going to be low anyway. But, and Morningstar actually brought out a report a couple of weeks ago, 20 days after the SFDR came into effect, collecting how funds have now self-classified themselves. And you see large variations. So I do think actually there will be some reclassifications as people have now learned, and as people are now able to compare their fund classifications to other fund classifications. So they'll upgrade and downgrade. We'll see a whole year of change. I'm not sure the taxonomy necessarily right now has a big impact on that.
No, I could agree with you. Anyone else input on that?
I think generally, regardless of taxonomy or SFDR, I suppose I expect to see some convergence around the Article 8 classification, and I think that would be kind of the minimum standard, or the kind of baseline, if you like, across the board and across the market going forwards, as investors become more familiar with the requirements, more up to speed with the reporting obligations, yet don't feel like they want to fully commit to the Article 9 additional requirements that they would be subjected to.
Thank you, Thomas. Well, I don't think we have much more time to ask questions. In conclusion, we can say that we all know that the EU taxonomy is a complex and a moving materia that needs to be digested, analyzed, and redigested again before usage. That's what you're basically portraying. The aim of the taxonomy is to contribute to climate transition by serving as guidance for investors, but the framework might be difficult initially because of lacking data, and there are a lot of uncertainties about the data, and will continue to be so during the next couple of years, even though you guys are doing the most that you can to eliminate that. And my point from all this discussion, that this uncertainty about data shouldn't encourage passivity. Instead, we need to work around those problems and start using the data so that we do have and create smart approximations and assumptions, just as we have done with financial data. And the data will only get better if you use it. If we don't question the data, it will never get better, and you guys will not be able to do the best job. So thank you very much, Hanna, Anne, Thomas, and Soeren, for your insights, and thank you all that attended the seminar. We at Swesif look forward to more transparency and more data regarding sustainable economic activities, and hopefully you guys can contribute to support us in making even better decisions. Feel free to visit the Swesif website, where you can take part in more information about our business and future seminars. Thank you very much for participating.